All right. Well, thank you everybody for coming out and tax workshop. I promise I'm going to try to make this as exciting as I possibly can. That's kind of a tall order, right? Because we're talking about taxes. And so a little bit about my background. I grew up in Upper Michigan, and the good old UP, Yooper. I'm a Yooper. Former Yooper. Escanaba. Grew up there, loved the outdoors, and my father worked as a financial planner for many years. He actually just recently retired, and we've had a lot of good conversation over the years. He's given me a lot of good advice, and my parents taught me about money at a young age. So when I was really young, I started off, doing a lot of different chores and stuff. And then when I was responsible enough to use a lawnmower, riding lawnmower, we had a really big yard, 5 acres. Now the whole 5 acres wasn't grass. I didn't have to mow that. That would be really huge. So I mowed a lot of grass though with the riding lawnmower, and they paid me. And I learned about credit too, because they would extend me credit and keep a loan balance, and I could pay them back. They didn't charge me interest, so that was really nice of them. I always paid them back. But my first, official job was cleaning an office building when I was 12. And then my first investment, I opened up a Roth IRA, and that's proven to be a pretty good decision. So, like I said, I had a lot of conversations with my dad about finance and yes, taxes and the whole thing. And it was when I was in college that I really decided I want to be a financial planner. This is what I want to do. So I graduated from college and got all the licensing that was needed. And it wasn't too long into my career, and I decided I wanted to serve in the Minnesota Army National Guard. So it was cool because I already had a college degree, so I could commission as an officer. So I went that route, and a lot of interesting experiences there. One of the things that was really valuable was the health insurance, because I was on TRICARE. Maybe some of you in the room have served. You understand TRICARE is really good insurance. So when my children were born at St. John's Hospital, we had a $25 copayment when they were delivered. That's it. So really good insurance, really good opportunity there. And I know I picked the right career, skill set, but what you enjoy doing. And I really enjoy helping people with finances. And I think I'm in a unique position to do so. There's a lot of people that are underserved with comprehensive financial planning, right? A lot of people might get some help with their investments or whatever, but when you pull in all these other decisions you're making with Social Security, what do we do with that? And maybe you have had a decision or have a decision about pension and then taxation and all this stuff. And so pulling that all together. So enough about me. Now we're gonna talk about your life, and you have your history, your goals, your principles. You have transitions. Some transitions are out in the future. Perhaps that's retiring. Maybe some of those transitions you've just gone through. Maybe it was children going off to college, empty nesters. Some of you maybe are helping take care of your parents, right? There's all kinds of different transitions. And then along with that, there's many implications for your total comprehensive financial plan, right? We talked a little bit about asset management, but it's not just that, picking the right types of investments and making sure you're allocated properly, but then distribution planning and how much do I take out from what account and what type of investments do I pull them from? And then estate planning, that factors in there, cash flow planning, risk management, and then of course tonight's topic, we're going to spend a lot of time talking about tax planning, because that's a real big one. It's really important. And so how many of you in the room prepare your own taxes? Just a quick show of hands. Okay, all right. And are you using tax software for that? Okay. Al, what kind of software do you use?
TurboTax.
TurboTax? Yeah.
12 years.
Okay. Any other software besides TurboTax that somebody's using? Tax Act, H&R Block has their version of the software too. Okay. Anybody do it by hand? Hand jam it. Judy, good for you. You're a trooper. You've probably seen this one before if you've been to our workshops, but I'll go over it again. I know it's tax time because I'm looking at all these documents and they don't make any sense to me no matter how many beers I drink. That's Dave Barry, comedian. Okay, we're going to start with the basics. The income tax brackets, we're using the 2018 brackets. And so the first one, and that, I don't know why it's showing up a little messed up there, it's $0 to $19,050 for joint filers, and single, $9,525. So the single rates thresholds are pretty close to half of the joint ones. So that's the 10% rate. Then we've got the 12% bracket. Okay, that goes to $77,400 married filing jointly for 2018. And 22%. Now we jump up. There's a pretty good jump there. 22% bracket's pretty big though. And then the next bracket up, it's only 2% more. We go to 24%. That bracket is also very big. So most Americans are probably not going outside of some of these brackets as we progress down. That's a taxable income of $315,000, right? So that's up there. 32% bracket, 35, and then 37. So we have a progressive tax code in the United States, and really all that means is the more you make, the higher the rate of tax that you pay on those dollars as you go through those brackets, right? And so line 43 is what you would take and then run that number and apply it to these brackets. Line 43, of course, is your taxable income. So you start at the top of 1040, Form 1040, and the income items go on the top, right? Earned wages, IRA distribution, your taxable portion of Social Security, those things. Then you subtract out the deductions, which for most people is the standard deduction. And then you get down to line 43, it's your taxable income. That's the number you run through here so you can figure out your tax bill. So I just got a quick question. Suppose that your taxable income is $77,400. You're married filing jointly. Let's just suppose that. And you pull an extra dollar out of your IRA or something and you make it go to $77,401. How many in here think that your tax bill would go up substantially? Show of hands. Substantially. Okay. How many think your tax bill would maybe just go up a tiny little bit? Okay. Yep, so your tax bill actually would just go up a little bit, and the reason is that dollars 0 through 19,050 are taxed at a rate of 10%. Okay, so then now that's done. That's done. You paid the tax on that first $19,050. Now this chunk of money, you pay that rate, 12%. So if only a dollar falls into the next bracket, which is the 22% bracket, you only pay the 22% rate just on that $1. So minor tax increase in that scenario. But this brings us to another point I wanted to make, and that is, what is your marginal tax bracket? That's very important to know. And the marginal tax bracket is really simple. It's just the highest one that you reach. So if you take your taxable income line 43, and let's say it's 79,000. Well, you're right here, right kind of in the beginning of this 22% bracket. And it's good to know that because now if I know my marginal tax bracket, and maybe I pull a little bit more money out of my IRA, or I do something that increases my taxable income, I know that because my marginal rate is 22%, the next dollar I pull out, I'm going to pay 22% tax on. But it works another way. It works this way. Let's say I put some money into my 401k, I bump up my 401k contributions, and that's going to go in pre-tax. So if my marginal rate is 22%, how much tax am I going to save on that extra dollar that I put into my 401k? I'm going to save 22% tax on that dollar because that's my marginal rate. Okay, so this is for ordinary income tax. Next, we're going to talk about investment income, which is taxed differently. Now, some investment income is taxed at ordinary rates. That would be interest, short-term capital gains, ordinary dividends. Those types of investment income are actually taxed at the ordinary rates. But we have preferential treatment on some investment income, and namely, that is long-term capital gains and qualified dividends. Now we have a different set of rates. We don't use those other rates for this. You got three rates: 0%, 15%, 20%. Now, very few people pay 20% on qualified dividends and long-term capital gains. You have to have a real large amount of income before you'd ever pay that rate. Most people are over here, and I just want to give you an example. Let's say that you retired and you weren't collecting Social Security yet, and you didn't have a pension, and so you might have $1 million in your IRA, but let's just say you wanted to do some stock sales in a non-retirement account. So you had a lot of stock in a non-retirement account, and you're going to sell it, but you've had this stock for years, and you've got a really big gain. You're going to have some capital gains when you sell the stock, but then you can use that money for retirement, right? You could realize a long-term capital gain of about $100,000, and you would pay a federal rate of 0 on that long-term capital gain. That's how that works. So really good, especially early on in retirement. Some people will use like employee stock purchase plan and things like that to maybe bridge the gap if they're not Social Security age yet, if you retire a little bit earlier, something like that. Now, one thing that you need to be aware of, when you change the other sources of income with regard to taxes, it's going to change a couple other things. In other words, if I change the amount of money I pull out of my IRA, it's going to change like 3 other things on my tax return. Well, this is one of them. So if I had, let's say I took $2,000 a month out of my IRA and I wanted to sell some stock. Well, now I've got $24,000 of IRA income, right? That reduces the amount of long-term capital gain that I could realize at the 0 rate. They add up, they count against each other. So my other sources are going to impact this, okay? Tell you a quick strategy. Sometimes this works, sometimes it doesn't. It's called NUA, Net Unrealized Appreciation is what it stands for. So some people work for a corporation, right? We have a lot of Medtronic employees that have retired, and you might have some employer stock inside your 401k. And it's called ESOP stock. ESOP stands for Employee Stock Ownership Plan. And what that is, it's contributions that your employer puts inside the 401k on your behalf, right? And they put it in the form of stock. But they keep track of the value, the cost of that stock at the time that they put it in, and then they get to deduct it. So there's a cost basis to that stock. They keep track of that for you. And then let's say that you had that in there for many, many, many years. The stock price maybe appreciates and goes way, way, way up. You might be in a situation where you have $150,000, let's say, of ESOP stock in your 401k, but the cost basis is only $15,000. It's very, very low. And so when you retire, you may decide you want to do a rollover to an IRA. And there's a number of reasons for that, right? Maybe you want the professional management, Maybe you want more selections. You want to be able to choose more investments because you have limited selection inside the plan. You might have more flexibility and control over how you take distributions out. Maybe you want to do some Roth conversions later on, right? So you decide you're going to do a rollover to an IRA, but that ESOP stock, that can come out at the time you do your rollover, and that can go over to a non-retirement account. Now there's one little thing that you have to do. When you pull it out and you put it over to your non-retirement account, you have to pay ordinary income tax on that cost basis. Now remember, if the cost basis is really low, that means that stock has appreciated a lot over the years. So that would be a good scenario for you if you were going to do something like this. If your cost basis was really high, it wouldn't even be a good option. Okay? So here's what happens. You roll over the rest of your 401k, it goes to an IRA, no tax, right? It just changes containers. And then the stock goes over to this non-retirement account. Well, then in retirement, you could sell some of that stock, and yeah, you have some gains in it, but you get taxed at long-term capital gains rates. Well, you can take some of the proceeds from the stock sale, and you can use that to fund retirement. If that money went over to the 401k, or if you kept it all in your 401k, and you needed to pull some money out, how would that be taxed? Anybody know? At ordinary income rates. It'd be just like taking a regular IRA distribution. So we have some clients, right, that can sell a nice chunk of stock every year, pay 0% long-term capital gains rates on it, use the money, and they might not even have to take distributions out of their IRA for quite a few years if they have a lot of stock. So I have one quick little word of caution with that. You want to make sure that whoever you're working with on this, that everything's been thought through. Don't want to make a mistake on this. We do workshops over the metro to the public, across the metro to the public, on this very subject. And we had a gentleman, he's not a client, but he came in for a meeting, and he worked at Valspar Corporation, right? Good paint. I used to like using Valspar paint. Anybody paint with Valspar paint? Yeah. So his company had a company for the 401k plan out of Boston. Starts with an F, ends with a Y. Out of Boston. You probably could guess, real big company, right? And one of the representatives told him, hey, you should do this NUA thing. You've got a ton of Valspar stock. He had $375,000 worth of Valspar stock in his 401k. And the basis was pretty low, right? So he was advised to take that out, pay the ordinary income tax and the basis, and then he could sell some of that stock and do this. Well, here's the problem. It wasn't a secret. It was in the news, and anybody that was paying attention probably knew about it. There was a big company that was interested in buying Valspar, Sherwin-Williams. We all knew about it. And Sherwin-Williams did buy Valspar after this gentleman was advised to do that. He moved that stock, that Valspar stock over there, into the non-retirement account, and then Sherwin bought Valspar. All the Valspar shares converted to Sherwin-Williams shares in one day. It was like he decided to sell all $375,000 worth of stock that day. Blew through the zero bracket, blew through the 15% bracket, and a big chunk of it was 20% long-term capital gains. Then, because he's such a high income earner, right, he had other income sources, and he had pension money and some stuff. And so he had net investment income tax, which is an additional 3.8%. So that got thrown in there. And then state of Minnesota, he paid a good chunk in the top marginal state of Minnesota income tax bracket, which is 9.85%. So he lost a big chunk of what he was counting on for retirement because he got bad advice. And this person that told him to do that just didn't think through the logical consequence of, hey, what happens when the deal closes and Sherwin buys Valspar? Well, that's what happened. So just a word of caution. Want to make sure that no mistakes are made when you're doing a strategy like that. It's a little bit more of an advanced strategy, right? There could be some hiccups. Okay, let's talk about tax deductions. So a deduction reduces your taxable income, right? What are some deductions? What are some things that you can deduct? Anybody? Charity, charitable contributions, yeah. Medical, if you get over that AGI floor, then you can start deducting it, right? You have to have quite a bit of medical expenses in most cases, yep. Mortgage interest, I heard, yep. How about state and local taxes right? You've got state of Minnesota income tax from the year prior, you can deduct that. Local taxes are property taxes, that's a local tax. And so not too many people are going to be itemizing moving forward, and instead they're going to take the standard deduction. There's two reasons. One, the standard deduction went way up with the new tax law. In 2017, married filing jointly, it was $12,700. Okay, now it's $24,000. So if I add up all those deductions and I can't get above the $24,000 mark, well, I'm not going to itemize because I'll get a lower tax bill if I take the standard deduction, right? So that's what most people are going to do. SALT, state and local taxes, that's another thing. So state and local tax deduction for purposes of itemizing is limited to $10,000. Even if you have more than that, it's limited to $10,000. So I'll give you an example. Let's say you're a high income earner, you've got a wonderful career, but you paid quite a bit of state income tax. Let's say you paid $8,000 to the state of Minnesota last year, okay? And then you're also fortunate enough, you have a really beautiful home and it's on a lake, but the property taxes are pretty high. It's about $9,000 a year you pay in property tax. So you take the $9,000 in property tax and the $8,000 in Minnesota state income tax, and that equals $17,000. Sorry, you can only use 10. It's capped at 10. You can't deduct the full 17. And on the old tax laws, you could. Okay, so that's another major reason. Okay, we also had a workshop attendee that was pulling money from a savings account, and he said, my tax bill's zero. And he was right, and that's great, your tax bill's zero. However, he could have pulled about an extra $10,000 out of his IRA, and he still would have had a tax bill of zero because he wasn't fully using his standard deduction. So the standard deduction, you want to use it all up. It wipes out, it reduces your taxable income, and if your taxable income hits zero, well then when you run it through the brackets that we just looked at, right, your tax bill is going to be zero. But if you can get money out of your IRA in retirement and pay zero, you better take that money out. You use it, you do a Roth conversion, you reinvest it in a non-retirement, you do something else with it. If you can get money out and pay zero tax on it, you use that full deduction. You want to fully utilize it. So how many people are either working part-time in retirement or plan on working part-time in retirement? Okay, great, yes, that can be a great opportunity. Now, there is something called the Savers Tax Credit. And I'll show you how it works. Here's an example. So let's say married couple, gross income $39,000, but some of that, just a little bit of that is earned income. So you're working a little bit part-time, and you take the standard deduction of $24,000. Now this example, this couple is 65 or older. They're over 65. So they each get that extra $1,300 added onto the standard deduction. So that makes it $26,600. Then you take and put $2,000 into an IRA contribution. You say, well, why would you want to do that if you're retired and then you're probably pulling money out of your investments? Why would you put money into an IRA? Well, so you can get the tax credit. So you put $2,000 in there, and it's a deduction, so that reduces your taxable income. And then it's $10,400 is the income subject to tax, okay? So you're in the 10% bracket, so you would owe $1,040 in tax for federal income tax. But then you get this saver's tax credit, and it's 50% of the maximum $2,000 IRA contribution you put in. So now you get to subtract $1,000 off of what you owe. Dollar for dollar, that's a tax credit. That's different from a deduction, right? Deduction, let's say I had a $1,000 deduction. That's only worth $120 if I'm in the 12% bracket. It's worth $100 if I'm in the 10% bracket. But if I have a $1,000 credit, that reduces my tax bill dollar for dollar by $1,000. Or to put it another way, that increases my refund by $1,000 if I'm getting a refund, right? So let's take a look at that. $40 is the tax due. Let's say that we had the same scenario, but I didn't put the $2,000 in the IRA and I didn't get the credit. My taxable income would be $12,400 times 10%, that would be $1,240 I owe in taxes. That's a difference of $1,200. So by putting $2,000 in there, I save $1,200 on my tax bill. It seems like a really good deal, right? Well, that's because it is. Good deal. Now, one little caveat. If your income, as it starts to creep up higher and higher, they're going to take away the saver's tax credit. You're not going to qualify. It's going to phase out the higher your income levels are. Okay? There we go. RMDs. So RMDs, required minimum distributions. Who knows when you have to take an RMD? How old? When you? 70 and a half. That's right. Okay. 70 and a half. And the first time it happens, you have a choice to make. Okay? You can pull out the RMD that tax year, that year that you turn 70 and a half, or you can defer it and say, I'm not going to take it out this year. I'm going to pull it out in the beginning of the next tax year. You can do that, but then you have to take it out by April 1st, okay? Well, then if you do that, you're going to have another RMD that has to come out that tax year too, because you have to take them every year. So you could have two RMDs in one tax year. Now, why would you want to do that? That might push you into a higher tax bracket. You're already forced to pull this money out, and you're going to pay income tax on it, right? Well, let's say you were working and you were a high income earner, and you turned 70 and a half, and you said, you know what, I'm going to retire at the end of the year anyways. I'm done. I put in my papers, okay? So you could defer that first RMD into the next tax year and then take another one. Well, you might be in a much different tax situation as soon as you retire. So that's one reason I could think of maybe taking the two in 1 year. You only have that decision the first time. After that, has to come out by December 31st each year. So what exactly is an RMD? Well, it's the federal government, the IRS, making you pay income tax on money that you haven't paid tax on yet. To be real blunt, to put it simple, right? Money went into the 401k, didn't pay tax on it. Money went into the IRA, maybe it came out of my checkbook, but then I deducted on my return. Didn't pay income tax on it. Account grew and grew and grew, had gains, dividends were paid out. I didn't get a tax bill on the growth either. It grew tax deferred. I never paid any tax on this money. And matter of fact, if I didn't have an RMD, and I never pulled any money out, it would grow into perpetuity. My kids could inherit it, and if they never had to take any money out, that money would just grow forever, compounding, right? So IRS says, the year you turn 70 and a half, okay, we let you do that, that's fine, but we want to start collecting some tax revenue on it, so we're going to make you pull some money out. And that's really what it is at its core. So how do we calculate the dollar amount that we have to pull out of the account? Well, first, you have to figure out the account value from the year prior. So the year that you turn 70 and a half, you have to look back to the prior year, December 31st. What was the December 31st account value? Take that number, and then based on your age, so you're 70 and a half, but you're 70 because it doesn't have half years on this thing. So you take that, divide that number by 27.4. That's going to give you the dollar amount that you need to take out. Now there's an alternative method, and that is multiplying it by 3.65%. You just take 3.65% out of the account, and you'll satisfy the RMD that way. As you get older, the factor goes down, and since you're dividing, that makes the number go up, or the percentage of the account you have to pull out go up. So you have to take more and more out as you get older. Okay, so $500,000 IRA balance at 70 years old. We are going to divide that by our 27.4 factor. 18,000 approximately is what you need to take out of the account. Does anybody know what happens if you don't take it out? They penalize you. They sure do. Does anybody know what the penalty is?
50%.
50%. You are correct. That's a nasty penalty. You never want to miss an RMD. Okay, so there can be some mistakes, right? If some people have accounts scattered all over the place and with multiple different financial firms and, all over the place, and that's fine, but you got to keep track of all that. Okay, so you got multiple accounts. There's penalties if you miss them. You got beneficiaries on all these accounts that you have to keep track of. You want to make sure they're up to date. What's this right here? QCD, Qualified Charitable Distribution. That's what that stands for. So let's say that you are taking the standard deduction. You take the standard deduction every year. Why? Because when you add up your deductions, they're not bigger than the standard deduction number. They're less. So you take the standard deduction, and you decide you want to make a charitable gift to a 501c3 or a church or synagogue or something like that, right? So you write out a check and you give, let's just make up a number. You give $6,000. Let me ask you a question. You're taking the standard deduction. You just wrote out a check for $6,000. Did that reduce your tax bill? No. It didn't reduce your tax bill at all. Why? Because you can't deduct it. You're taking the standard deduction. You added up all the deductions and they were less than the standard deduction. Okay, something happens when you turn age 70 and a half and you have RMDs, Qualified Charitable Distribution. When I turn 70 and a half, I can give that $6,000, which I give every year, to the same charity. And that's what I want to do. Those are my intentions. But I have an RMD I have to take out of my IRA. So I can tell the custodian, LPL or whoever, the holder of the account, I can tell them, hey, I want to make a qualified charitable distribution. So will you send this entity $6,000 for me out of my IRA because I'm over the age of 70 and a half, and I have RMDs I need to take out, and I'm going to satisfy part of that RMD. If it goes directly from the custodian, it does not show up as income to you on your tax return. So we just talked about if you're taking the standard deduction and you write out a check, doesn't reduce your tax bill. Does this reduce your tax bill? Yes, it does. Yes, it does. That income does not show up on your tax return, and you still take the standard deduction. So you're getting the benefit of itemizing, even though you don't have enough itemized deduction, as long as you send it directly from the custodian to the 501c3 or charity. Okay? Tell you a quick story. We have a client, his name's Mark, and Mark is not 70 and a half. He's actually 59, but he's helping his mother with her accounts. His mother lives in Arizona. She's in her 80s. She has some early signs of dementia, okay? And she gets inundated with mail, count statements, prospectuses, annual reports, proxies for voting for shareholders, all this stuff, right? And she just gets it in the mail, right? So you can sign up and you can go paperless. There's, change the address. There's some other things you can do. What did we recommend for Mark helping his mom? We recommended that consolidate. She has 5 accounts. 3 of them are IRAs. 2 of them are from a prior employer. They're employer-sponsored plans, okay? She could take all those accounts and put them into one IRA, and that would simplify things. Well, guess what? She has RMDs on all 5 accounts, and the thing with the mail, what I was getting at was they'll send you a notice with your calculation for what the RMD amount is for each account. But if you have a bunch of mail and stuff, you might throw it away, you know. And it's just the number. You have to act on it. You have to call them up and say, oh, I didn't realize I have to take $3,743.17 out. Would you please send that to me? I'd like to make sure I satisfy my RMDs. You have to let them know. So Mark's helping her with that. Okay, so consolidate them all into one account. Here's another thing. There are beneficiaries on all 5 accounts, okay? Well, Mark's mom is eventually going to pass away, but Mark has 3 siblings. So 5 accounts, 4 beneficiaries for each of the 5 accounts. That's 20 beneficiary claim forms to fill out for Mark if he's helping settle the estate, right? 1 IRA, 4 beneficiaries, done. Simplify it. Okay, we want to reduce the possibility of mistakes. Okay. One other thing. IRAs you can mix and match. So if you have, let's say you have 2 IRAs and you have the RMD number for both IRAs, you can add them up and say, I just want to take it out of this one. Or you can split any way you want, as long as at the end of the year you took out from all IRAs that you own and added up the amount of distributions and it was equal to or greater than the amount of RMDs. You're good, then you're satisfied. You can mix and match. You can't mix and match employer-sponsored plans, though. So if you have an old 401k and then an old 403b, and you have an RMD for each, you have to take that RMD out of that account. You can't mix and match them with employer-sponsored. You can with IRAs. Okay, any of you ever watch Looney Tunes ever, growing up, Bugs Bunny, Yosemite Sam? Yeah. Wile E. Coyote and the Roadrunner? Those are particularly funny, I thought. And so Acme. Acme's on everything, right? So I remember one episode, and Wile E. Coyote's in this little shed, and he's got some boxes with some parts, and they say Acme on the boxes, and he's assembling this bomb, and he's going to outsmart the Roadrunner. Now today, he'd probably be labeled as a terrorist and Homeland Security come in and all that, but okay, hold that thought. Wile E. Coyote making the bomb, hold that thought. I'm going to bring that back in just a second. Does anybody know what the highest federal income tax bracket was ever in the history of the United States? Anybody know? 90. Pretty close. It's actually higher. Pretty close. Just a. It was actually 94%. In the 1940s, after World War II. Now, not too many people paid that 94% rate. You had to be, probably considered fairly wealthy, a real high income earner, okay? But it was $200,000 then. Anything over $200,000. If you adjust that for inflation for today, it'd be $3.2 million. So, a famous athlete or somebody. Can you think of anybody in the 1940s that maybe would have paid that rate on some of their income? Any ideas? Rockefeller, yeah. Carnegie, yeah. Sure. Okay. Well, there's an actor in California, and later on became the president, by the name of Ronald Reagan, and he would make 2 movies a year, and he got paid about $100,000 per movie. And after that, he said, I'm done. That's it. Why would I keep working? Now, 94% of it's going to go away. And who got the rest of it? He probably didn't even, I don't even know if he could get anything after that. Probably the other 6% went to, what? State of California. They probably took the rest of it. So, done after 2 movies. Okay, so 50s, 60s, 70s, it was, the highest bracket was 70%, highest top marginal bracket. Then it was changed to 51%. In 1981, who became president? Who was president? 1981? Ronald Reagan. He decided to do something about it, I guess. So, and then 90s and 2000s, it was about 40%, right? It was just 39.6 was what it was before the new tax code. Now the top marginal bracket is 37%. We just saw it. Okay. Why do I bring this up? And why is there a bomb up there? Okay, tax probably going to go up. Yes. Yes, tax rates really were a lot higher looking back in history. Today, tax rates are, pretty low when you take it all into context. So, anybody in here ever see the U.S. debt clock? Just Google it, U.S. debt clock, and you see the meter just running. National debt, and it's about $22 trillion. By the way, I just did a workshop earlier this week, and that thing, I don't know if it changed the rate that it was going up. I was like, wait a minute, doesn't the government shut down? Shouldn't that slow down the clock? But I don't know if it did. So, if you look on there, they show the budget items, and they kind of break down, right? The largest budget items, Medicare, Medicaid is lumped into one. That's over $1 trillion. Social Security it's like $999 billion. It's almost $1 trillion. And then in third place, a distant third at $670 billion is the defense budget. Okay? Then if you scroll over a little further and you go down to the right, it's got all kinds of metrics on it, right? It shows U.S. retirees, the population of retirees. That goes up by 10,000 a day. Baby boomers. Or 1946 to 1964, 10,000 a day are retiring. Well, what do you do, after you retire? You file for Social Security benefits, and, when you're eligible, when you're 65, you sign up for Medicare, right? Okay. So demographics, all these things are happening. We already talked about rates, what we think will happen in the future. They'll probably be higher. So government spending would actually have to be cut in half for the current rates to work, for that to be sustainable. Or, you flip it around, tax revenue would have to double approximately, for the current rate of spending if we don't change that. So, okay, back to Wile E. Coyote. Wile E. Coyote building the bomb, and then the Roadrunner comes up behind him. He doesn't have hands or anything. I'm not even sure. He pushes the shack onto the railroad tracks because, there happens to be railroad tracks there. And Wile E. Coyote's working on the bomb, and he hears a loud roar approaching. And of course, it's a big, huge freight train coming. And he looks out the window in the back, and the freight train's coming. And what do you think he does? He grabs the cord on the shade, and he just pulls it down, and he goes back, and he starts working on the bomb again. Right. Well, then the train smacks into the thing, and everybody laughs. Funny, right? Because it blows up, and, Wile E. Coyote failed again. The point of that story, the reason why I bring it up, is because we don't want to be like Wile E. Coyote, right? We want to think ahead and plan. And when we're looking at our investments and our income plan and our IRAs, thinking about, the tax bill that we're going to have, how do we meet our retirement income needs and minimize taxes? Earlier, I told you the story about the gentleman that wasn't fully utilizing his deduction. Well, he could have pulled another $10,000 out of his IRA and he still would have had a tax bill of zero. Well, get that money out of there because there it is, your nest egg, a big chunk of it. It's sitting there and there's a future tax liability. You're going to be forced to take some out when you're 70 and a half. And I don't know what your tax bill is going to be. I can't tell you because it's in the future and tax rates might be going up. Okay? Okay, we're going to talk about Social Security. Another thing that can happen and take somebody by surprise is that, hey, I collected Social Security, I got to the end of the year and I owed a bunch in taxes. I didn't realize my Social Security was going to be taxable. Well, it is, and it's a little tricky because it's a formula. How much of my Social Security is going to be taxable? Well, you got to add up your ordinary income, dividends and capital gains, non-taxable interest. So you're taking all these other income sources and using that to determine how much of your Social Security will be taxable. For some people, Social Security is tax-free. If you have a lot of IRA distributions and some pension income, maybe you're paying tax on 85% of your benefit. That's the most that can be taxable. It stops at 85%. Okay? 15% is always going to be tax-free, the federal level. So there's this formula for calculating that. Provisional income is a part of that. The IRS has a worksheet if you want. There's a bunch of steps. There's online calculators, and of course we do that for our clients too. Okay? So I'm going to give you an example. Social Security tax reduction. This is kind of a pet peeve of mine too. Sometimes, people want to know, how do I maximize Social Security? And it's not super simple because there's other factors. But if you read on the internet and you look on little calculators and you go online, they'll just ask you, what's your benefit? What's your birth date? And if you have a spouse, what's theirs? And kick out, collect here and you'll maximize Social Security. Well, first of all, it depends on how long you're going to live. Hello, we don't know how long we're going to live. But then what about my other investments that I have? What about the tax bracket I'm in? What about, if I'm really risk averse or if I'm invested aggressively? Wouldn't all that stuff play in to answer the question, when should I collect Social Security? Sure. So it's being oversimplified. Well, here's an example. For every additional dollar you take from an IRA, this is a person, $30,000 Social Security income, $35,000 from a pension, okay? You take an extra dollar from an IRA and you cause another 85 cents of your Social Security be taxed. If you look on your 1040 and your tax return, line 20A, that's all the Social Security you've collected throughout the year. Line 20B, that's when you put the taxable amount. You put that there. So apply the formula with all the other stuff, and then you figure out the number for line 20B. So in this case, you pull out an extra dollar, and it's making 85 cents go from line 20A. It's adding to the amount that's in 20B. So you took a dollar out of your IRA, and your taxable income went up by $1.85, is that right? Yeah, that's right. That's how it works. 85 cents of it's from Social Security that was not previously taxable, and now it is because you just pulled out another dollar and changed the formula. You change one thing on the tax return, and 3 other places it changes. They all kind of work together, right? So, 12%, let's say you're in the 12% marginal bracket. And then you add 7% state of Minnesota income tax, it's 19%. 19% of $1.85 is 35 cents. You pulled a dollar out and your tax bill went up by 35 cents. Your effective tax rate is 35%. That's called the tax torpedo. All right. Daddy, what does IRS stand for? Income Redistribution. Harold! Did I get that right? Okay, Social Security maximization. Remember when I was talking about the break-even calculators? They don't know what tax bracket you're in, right? So I'm going to give you 2 examples. Married filing jointly couple. over the age of 65. They want $70,000 in income, okay? And they're figuring out, what are we going to do with Social Security? Why don't we have you take yours and I'll defer mine? Okay, one of them takes it and the other one defers. They want to defer. One of them wants to defer. Okay, so they do end up with some Social Security. They take $20,000. One of them is claiming, the other one is deferring, but they need $70,000 total. Well, let's pull the other $50,000 from the IRA, okay? And that gives us taxable income of $67,000. Minus the standard deduction, $26,600. Taxable income, line 43, $40,400. Federal tax bill of $4,467, right? Okay, add on some state income tax, it's well over $6,000. Okay, now, same couple, hey, why don't we just both claim right away? Let's both collect. $50,000 of Social Security income. Look at the taxable amount. It went down. They're collecting a lot more in Social Security benefits, but the taxable amount went down. Why? Because of the formula, because of your other sources. Well, now we only need to take $20,000 out of the IRA because we're getting $50,000 from Social Security. So IRA ordinary income item. IRA distributions are taxed at ordinary income. Much smaller amount, and now our total taxable income is $26,850. We take out the standard deduction. We get to the actual taxable income, that's line 43 again, $250 times the 10% rate. You're in the 10% bracket at this point, $25. Call this the new car slide. So you could do it that way, or you could do it that way and save over $6,000 and maybe buy a new car, right? $500 a month, the payment, or do something else with it. But big difference on your tax bill just on how you claim Social Security. Okay, anybody know who this is? Einstein. Yes. So Einstein, you know what? This reminds me of a quote. My chemistry teacher in high school used to say, what was it? There are three things in life that are absolutely for certain. You probably know two of them. This was a chemistry teacher, right? Okay, so anybody hear this? Yeah. Three things in life that are absolutely certain. Death, taxes, and the half-life of radioactive elements, the decay, the half-life. Chemistry, okay, sorry. Okay, Albert Einstein was a brilliant man. He actually came over originally from Germany. There was a team of scholars, experts, trying to solve the problem. How do we get enough uranium, refined uranium, to make a nuclear bomb? That's what he originally came over for, but he was a teacher at Yale for 20 years. And he was 3 semesters in, and the faculty came up to him and they said, Albert, they're on to you. You got to change your exam. Your questions are the same, and the students, they get it. They're not going to study. And he put his foot down. He said, no, I'm not going to change it. The questions are going to remain the same. And they did. He kept them the same. And they wanted to know why he wanted to keep the questions the same. And his answer was that the answers keep changing. Same question, different answer. I'll give you an example. This applies to taxes because the question is, what? What are people, is there anything we can do to reduce my tax bill? Am I doing this right? Should I pull this? How do I pay the least amount in taxes? That's the question. Everybody asks that question. What is the answer? Keeps changing. They keep changing the tax code. Every time the tax code changes, you get a different answer. Same question. I just want to reduce my tax bill. How about investments? What's a good investment? How should I be invested? Same question. What's the answer? I don't know. A great investment 10 years ago might be a lousy investment right now. Okay. One other thing, Albert Einstein was once asked, Albert, what do you think is the 8th wonder of the world? And he paused, He thought about it, and he said, compound interest. Compound interest. Okay, how does that apply to money and taxes? And, well, we just talked about taxes maybe will go up in the future, right? A big chunk of your nest egg is maybe in IRAs or 401ks, right? And you're going to have to pull some out, and we're not sure what the tax bill is going to be. And even a non-retirement account, right, where you pay tax on the gains, you'll lose some of that money to the federal government and the state in the form of taxes. Well, your compounding effect of that money over time is reduced by taxes. You have to take the money and you remove it. You give it to the IRS or the state. You're reducing the compounding effect. How much is that on average? It may be 1 to 2% a year, if all things being considered, that you're losing, and it's being removing from compounding. Okay. Anybody know what this mountain is? It is. It's a picture of Mount Everest. So if I should stop in it. Has anybody climbed Mount Everest in here?
I'm a liar.
Oh, okay. All right, well, not too many people climb Mount Everest, but every year people try, and some people, unfortunately, die trying to climb Mount Everest. So there's a ton of planning and training, and maybe equipment and all the stuff that goes into these people are trying to climb. They hire Sherpas and get the right route and all that stuff. And yeah, how many in here think more people die on the way up, or you think more die on the way down? On the way down. That's actually right. More people die on the way down. And who knows, could be equipment running out of supplies. It could be something to do with oxygen. I don't know. I'm not a mountain climber. Maybe weather, maybe a storm comes in. And if we apply that to investments, a storm, that could maybe be a severe bear market, right? You apply that to your investment situation. And you work hard all your life and you stack money away and you put it in your 401k and maybe you put it in an IRA or a Roth IRA, and it's fairly straightforward. Yeah, you want to pick good investments and make sure the allocation's appropriate, but it's fairly straightforward. You get to the top and it's time to retire. Now you got to come down the mountain, and all of a sudden you're faced with all these questions. Well, how do I get that money out? What account should I pull it from? How much of my Social Security is going to be taxed if I do that? Should I sell some of the stock? That NUA thing, should I do that? What about my pension? I'm not sure if I should take the lump sum. And there's all these decisions, right? And so we specialize in not only getting you up the mountain, but getting you back down. And unfortunately, not everybody does that, right? Some people, or maybe in the past you worked with a financial professional, and you said, you're going to have to talk to your tax person about that, and they won't help you. They won't help you and show you how much of your Social Security would be taxable, those other things. Okay. Quick recap. We talked about tax brackets, capital gains and qualified dividends rates. We talked about deductions and tax credits and the difference. We went over Social Security taxation. We talked about RMDs, tax mapping. We do that here, right? Use that as a way to see where you're at and what scenario might be the best way to get money in retirement. We talked a little bit about investments and income planning. Okay, so I'm going to go ahead and just open it up to questions, if you have some questions. Yeah, go ahead.
I have a small amount that my parents put into an insurance policy for me.
Okay.
If I cash that out,
Yes.
I pay taxes on it.
Great question. Question is, if I cash out my insurance policy, do I pay taxes on it? Okay, so your insurance policy has a cost basis. That is to say, the premiums that were paid into the policy. Now, during the life of the policy, there might also be a cash value. And maybe that cash value goes up over time. If As you age, you might get to a point where it starts shrinking and going back down. That's because the cost of insurance inside the policy is changing with your age. Now, if you cash out the policy, will you have a gain? It's a phone call away. All you have to do is call the insurance company and say, I'd like to know what my cash surrender value is. Write down that number. Then the next question is, I also need to know what my cost basis is in this policy. Write down that number right below the cash value.
What was that called?
Cash surrender value and cost basis. Subtract the cost basis from the cash surrender value. If it's zero or a negative number, you can go ahead and cash it out. You won't owe a penny. No tax liability, none. If your basis, let's state it another way, if your basis is lower than the cash surrender value, whatever that difference is, you're going to pay ordinary income tax on that amount in the year that you cash it out. Good question.
Just that amount.
Just that amount, just the amount over the basis. Yep, in the back?
But often the benefit to your beneficiaries of an insurance policy is like twice the amount of what your cash surrender value is. Like, if you waited and died, your beneficiaries have $50,000, whereas
Right.
if you do that now, you very well, are looking at half that value. So
Right.
it's no benefit to your beneficiaries for sure.
Right. And, and you have to die. There's that. Right. Okay, any other questions? Yeah. Al, go ahead.
Completely invisible to me, but this must get handled. I mean, you guys get rollovers from other IRAs, and like in my case, for things all the time. There's
Yes.
Cost basis in there somewhere that I have no idea what is and never shows up on a statement, but that gets preserved
Right.
during these rollovers, right?
Well, so
If I
that,
take some out, that's less the fair share of what I paid in.
right. So it's all taxable as ordinary income when it comes out. So keeping track of the cost basis is irrelevant unless it's ESOP stock, we talked about that. Or what if you have after-tax contributions? Not too many people have that, it's fairly rare. Now you got to keep track of the money that was in there that you put in after tax and keep it separate from the money that you put in there pre-tax. I'm not talking about Roth, because there's a Roth option in the TSP too. Yeah,
And I mean, whether it's a gain or what you put in tax-free, it's all treated the same.
it's all treated the same. Absolutely. You can buy and sell and wheel and deal inside your IRA. You can get dividends paid to you and have all kinds of activity inside the account, right? You could be a day trader inside your IRA if you wanted. Are you going to create a single penny of tax liability in your IRA by the activity inside of the account? No. Not till you take a distribution. You take a distribution out, okay, 1099-R, custodian's keeping track. They're going to send it to you at the end of the year. You're going to pay ordinary income tax on whatever dollars came out in the form of a distribution. But buying and selling and investment income and cost base, none of that stuff matters inside of a 401k IRA. Yep. That matters inside your non-retirement account. That's the opposite. Your non-retirement account is the opposite of an IRA. You can put $1 million in a non-retirement account, turn around, pull $1 million out. It's after-tax money. You don't owe a penny in tax. Now, inside that account, you buy some stock, you hold on to it for 6 months, and the stock price goes up a little bit, and then you sell it. You just created a short-term capital gain. And you don't have to take the money out to have realized the capital gain. All you had to do was push the button that says sell. Activity. Activity in a non-retirement account is going to trigger a tax liability. IRAs, only when you take a distribution. Okay, good questions.